So today we're gonna talk about real estate. One of the hottest topics that people wanna talk about right now is real estate, because during the pandemic, after the pandemic, and even before that, everybody plowed into real estate. Why? Because it was on fire. Everybody was saying real estate's made more millionaires than anything else, and that's true. Everybody plowed in because it was going up and up and up. It's easy to understand why real estate skyrocketed after the pandemic. When we came down for the V, people were like,
Oh my God, what's gonna happen? Oh my God, my house is lower. Oh my God, what do we do? People aren't paying rent.
and all of a sudden it V'd and it went straight to the moon. Or did it actually make it to the moon? Because the Fed lowered interest rates. And when they lowered interest rate, it made money super cheap. So everybody that wanted to buy real estate, all of a sudden now could get money really inexpensively from the banks and from the institutions. Not only that, the Fed printed a whole bunch of money. So now people actually had savings. They had money. They had saved up some money. They had reduced down their debts. They could buy. And boy, did they ever. But you know, they weren't alone. The hedge funds started buying, BlackRock, Blackstone, and so many others. You even know of Zillow and what happened there. They bought up neighborhoods. They bought up middle America. And they paid full price, if not more, driving the price up. But the biggest question I have for you, and the biggest question I get asked, what's next? Well, my name's Chris Naugle. This is What Now? What's next? So I know some of you are real estate investors, and I know what you're thinking. Buy, buy, buy. Prices in certain parts of the country have come down in price, so they're off their highs. If you're in San Francisco, your pricing has dropped 20%. Now, some people get a false signal and say, this is a buying opportunity. I gotta start buying. Why? Because there's a lot of money coming to them, right? If you're an institutional real estate investor, you wanna buy because you got a lot of money that you need to move. Investors give you money into your fund or into your whatever structure you are, your syndication, you gotta move that money out and you gotta buy real estate. But let me throw some caution to the wind. Anyone that's buying real estate right now must abide by some very important rules of engagement. Some best practices, shall I say. If you're buying real estate right now, the chance of you making money in appreciation alone is probably zero. Unless you're really getting a golden deal, which there always is a golden deal out there, the needle in the haystack, if I will. If you're getting one of those, great, but you shouldn't play the long game. And a lot of people, they're playing the long game. They're buying these big multifamilies. They're putting millions, tens of millions of dollars to work into these properties, and they're buying them today at today's pricing. Here's the downside. Now, although the buying today at today's prices is buying high, it may not be a bad thing, because you know what? There's a lot of people that need housing, so there's a lot of renters that will pay rent for those properties. But you better not have the wants, the need, or the desire to sell those properties in, well, the next 10 years. 10 years, Chris? Really? 10 years? Well, let me put my glasses on so that I look smart. Yes, sir and ma'am, 10 years. Why? Because it's a market cycle, folks. It's a cycle. We're on the way down. It's just part of what happens. If you understand cycles, you'll understand this. You probably don't understand this, and the only reason you wouldn't understand this is you're too young. The last time this kind of a cycle has happened was almost 14 years ago. Some would even say this is part of a 25-year cycle, so most people have no idea what's coming, and they're being completely oblivious to it. You see, right now, it doesn't seem so bad, does it? When you're going out to the restaurants, when you're going to the bars, people are out eating, they're all having a good time. You go to the airport, it's still packed, flights are still full, people are traveling, hotels are booked, and it's a good old time out there. Who cares that the Fed's raised rates 8 times so far? Who cares that the Fed's unwinding $90 billion a month from their balance sheet, which is like putting a vacuum cleaner on the central banking system and just sucking all the money they printed back out? Who cares about that? Man, it's good times until it's not. You see, when we talk about real estate is a lagging indicator. So let me define a lagging indicator. It's just what it sounds. It lags. But what does it lag? It lags the stock market by 6 to 8 months, generally. That can change a little bit. So what does that mean? Well, since the stock market's going down, oh, you haven't checked your 401k statement? You haven't looked at your brokerage accounts? Should. They're probably down 20 or 30%. Just put it out there. This is March of 2023, and yes, your investments, if you didn't make changes, are down, oh yeah, double digits. Sorry about your luck. You should have been paying attention. We do this show every week. Do you know that? You know, actually, let's just take a pause real quick. So there's some of you that are like,
Holy crap, you told us not to keep our money in the market. You told us we need to be careful. You told us this was coming.
yeah, I did. And actually, why don't we reset and get on the right page? So right now below, click that subscribe button, and you know, that little bell up there, maybe it's on your left or right, smash that bell so that you're notified every time I put a new video out, so you can be in the know instead of being out of the know. All right, let's get back on with the show. So because it's a lagging indicator, when you talk to realtors right now, I just did a show a second ago, and there was a couple realtors out there, and they think it's freaking party till it's, well, you know, back in the day it was party till it's 1999. Now what is it? Party till it's 2024? Something like that. It's a big party. Oh yeah, when houses go on the market, they're flying off the market. Oh, we can't keep houses. They're going over ask. Oh my God, there's no inventory. Ha, lagging indicator. When you talk to a realtor, you're getting old news that is not relevant for where we're going, because real estate hasn't really felt the pinch yet. What pinch? Well, let me read you an article from today's paper. Fed Chair Powell says interest rates are likely to be higher than previously anticipated. Home prices could face double-digit drops in these cities. And then they mention a bunch of cities. So your realtor tells you that things are hot. Your realtor's saying prices are going up. Your realtor's saying you should buy this property because the prices are going up, up, and up. They are not in the know. Can somebody please tell them about this YouTube channel? And also, remember, just click the subscribe button and hit that little alerts button. You tell them that. They need that. Yeah, no, really, tell them. They need the help. I know they don't want the help. They act like they know everything, but they need it. All right. So if it's a lagging indicator, then it's not really a good place to look to know where we're going. But you know what is? How about truck drivers? You know any truck drivers? They're awesome people. Truck drivers, men and women that drive trucks, moving our goods and services. And then how about our railroaders? Anybody in logistics? Talk to them. Ask them what's going on, because they're slowing down. They're slowing down. Fuel prices are up and the price per load is down. So a lot of them, they can't really make sense of it. It's an interesting thing because they are a leading indicator. Remember, real estate's a lagging. Truck drivers, logistics, leading indicators. So if we want to know where we're going, then that's where you look. You look at the leading indicators, you ignore the lagging indicators, because the lagging indicators give you bad information. Employment numbers, lagging indicator. Why does it feel so good out there? Why does it feel like everything's going except, well, yeah, eggs are more expensive. Oh yeah, food's only increased by 100% or more. No big deal. I got a job. Oh, you nailed it. You got a job. You're still employed. You still got a paycheck. So you can party like it's 2024. And we can continue on with this party until you can't. And the buck ends, and the party stops, and the music ends when you lose your job. And for many of you watching this, you will lose your job. For many of you watching this that are self-employed, your business will go down. I don't mean go down in flames. I just mean your sales will go down. Your business will slow. I'm not being a jerk. I'm just being realistic with you. And how do I know this? Well, I know this because I've studied this for a long time, for over 20 years. I've studied cycles, studied patterns. I've studied the markets. I've been in Wall Street as an advisor for 16 years. I know what the cycles look like, but I didn't always know what I know now. Back in the day, for me, because I'm a little older, it was party like it's 1999. I thought it would never end until I got bit by the first recession that I actually felt the pinch on. And, well, watch my other videos to hear that story. But this is your story. This is the story you're writing, not me. Your story involves real estate. And your story has, well, a few cracks in it. And those cracks are the fact that you think your real estate's going to keep going up in value. And that is a delusional thought, because it won't. It's gonna go down in value. Your property next year will be worth less than it is this year. I don't care where in the country you live. Your property in 2 and 3 and 4 years will not be worth what it is today. So if you need to sell it, if you need to turn some capital, if you need to refinance it to buy out some investors, you're not gonna be able to. But you will be able to, but you won't get the full value that you can get today. As long as you understand that, it is party like it's 2024. But also what you need to realize is if you're counting all those pennies from your Airbnbs and your multifamily rents, understand something there too. During a recession, some of your tenants will not be able to pay rent. Some of your tenants will have to be evicted. Some of your tenants will go months without paying rent. Your Airbnbs, yeah, well, they won't make as much as they are today. They will make less. Maybe you'll get lucky and you got a really unique property in a unique place where people have to go. But outside of that, for the majority of you, your Airbnbs will see less income. And how do I know this? Well, let me tell you. Let me give you some actual stats here. In 1929, construction of residential property fell 95%. Now, if you look at the home builders of this country right now in 2023, you are seeing decreases. You're seeing numbers very much like what you saw in 29, but not 95% yet. Lagging indicator. In 1932, between 250 and 275,000 people lost their homes to foreclosure. It's really a small number by overall scale, but we'll get to that point as we get a little closer to today's date. In comparison, 68,000 homes suffered foreclosure in 1926. But that was then and this is now. Let me keep going. By 1933, foreclosures reached the appalling rate of more than 1,000 each day. Housing values dropped by approximately 35%. Child's play. A house worth $6,000 before the Depression was worth $3,900 in 1932. For you real estate investors, what are you thinking right now?
Man, if I could go back to 1932, that would be a heck of a bargain. I would have been buying houses almost half price.
Keep that thought. Let's move to 2007. Now, many of you were too young to realize what happened during the Great Recession, but it really wasn't that long ago. So let me read you some facts about that. Housing prices dropped by 33%. Remember in 1929, they dropped by 35. In 2007, housing prices dropped by 33%. Remember that thought? Oh man, I wish I could take that DeLorean back to 2008, 9, 10 and buy some real estate, 33% off. Yeah, over 6 million households foreclosed. The average household debt in 2007, pay attention. Mortgages, the average household debt had a $114,000 mortgage. They had $12,133 in credit card debt in 2007, and the average car cost was only $23,900. The average household debt today, the average mortgage is $222,000. Credit card debts, $17,000. Average car cost, $41,665. If we index all of those numbers from 2007 for inflation where we're at today, we get a really clear picture of where we are, but then where we're going. You see, I gave you 2007 numbers. The Great Recession didn't happen until 2008. And it all fell apart. It all fell apart. See, people are spending way too much money right now. They're spending way too much money and they're bulking up their debts, which is the exact opposite of what you want to do to take advantage of the opportunities that are coming. Because just a second ago, you're like, oh wow, I wish I could have went back to that time and bought houses almost half off. I wish I could have went back to 2009, 10, 11 when houses were more than half off. But you can't go back in time. But you can get ready for what's about to happen, which will be the same thing I just told you happened in 1929, the same thing that happened during the Great Recession. It's going to be a real party like it's 2024, but the party has a reservation list. And the reservation list is very small. And I don't know if you're on it. Let's talk about what the big guys are doing right now. What do the hedge funds doing? What are the big investors like Bill Gates, Ray Dalio, Warren Buffett, Charlie Munger, Robert Kiyosaki, and, well, all the rest of them? What are they doing? Well, they're getting ready. Warren Buffett, he's got an awful lot of cash sitting around. Okay? These other folks, Ray Dalio is out there warning everybody about what's about to happen. And Ray Dalio, if you don't know who he is, which many of you don't, one of the smartest minds in money, in finance, and in the stock market. He owned the largest hedge fund in the world called Bridgewater Capital. Look it up. Bill Gates, no secret, he's out there buying land, buying farmland. Why? Well, that's where they make our food, folks. He's no dummy. You may like him, you might not, doesn't matter. But they are preparing. They are getting diversified. And when I say diversified, they're diversifying their asset classes, not diversifying.
I got some small caps, some mid caps, some international mutual funds. I got some of those large caps over here. Yeah, I got some of those target date, freedom date fund thingamajiggers that they gave me in my 401k.
But that isn't what I'm talking about. I'm talking about diversification of asset classes. I've got my real estate portfolio. I've got my IBC, specially designed whole life portfolio. I've got my treasury bonds in my bond portfolio. I've got a couple stocks, but not many. I've got this. I've got some commodities. I own some positions in these companies. Asset class diversification. That's what they're ready. And you know what else they're really ready for? Well, they're ready for not having any debt, because they don't have any debt. You see, that's the number one thing that will take a household down during a recession. You want to get ready for what's happening? You want to get ready for this big opportunity? Wait for it. Get out of debt. Oh, let me repeat that, but hold on, let me look smart. To be prepared for this recession, what you must do is get out of debt. That's right. You go into this recession loaded in debt, you're not going to be ready for the opportunity that's about to present itself. That's a crying shame. It's really sad, because it's going to be a big opportunity. Yepper. There's going to be a lot of people out there buying houses 30, 40, 50% off. There's going to be an awful lot of people out there buying up stocks 50, 60, 70% off. But, well, like I said, the reservation list for this party is really small, and you might not be invited. So I'd suggest you do a budget. Sit down in your household with your significant other or your spouse and draw a line down the middle of a paper and do a little T-chart. On the left, put down your income. Now, you're disqualified if you only have one income, because if that income goes away, your whole house of cards collapses. So if you've got two incomes, we're a little better, but how about we try to get 4 or maybe 5 incomes? So on that left side, all your incomes go there. Now don't leave any out. Well, husband's salary, my wife's salary, yep, we got that side hustle, we got that Amazon store, we got some income coming in from our duplex, great. Because now if one goes away, the other ones are still there, and that's what we want. But on the other side, this is the most important one. You gotta put your debts over there. Your household expenses, yes, but on the bottom, I want you to put all your debts. Yeah, those credit cards, lines of credit. Remember your line of credit? Remember last year, year before? I think it was like 2-3%. Man, we were like, this is so awesome. I get to use the money, that equity in my house. I get to use it for 2-3%. And now I just looked at my mother's home equity line of credit, 9.25%. Now for her, it's no big deal because we lend her money out at 12%. So we're still making a spread, but it's way smaller. You see what I'm saying? It's good debt and bad debt, but all debt is bad going into a recession. So clean up that balance sheet, clean up that budget, pay off those debts, stop going on trips, stop going out to eat every day, stop going out and drinking once a week with your friends because it's fun. I get it. This is the time to hunker down, the time to cut some things. Maybe you got to get yourself a second job, a third job, a fourth job. Maybe you got to go clean some horse stalls. I don't care what you do. Make the money to get rid of the debt, because if you do, we'll be reading about you in the papers. You'll be the next rags to riches story. Maybe you're not in rags. You'll be the next success story, whatever you want it to be. Maybe you'll even show up on the cover of GQ magazine because you prepared and you took advantage. Doesn't that sound cool? It does to me. Now, what opportunities should we be looking for? Because, keep talking about all these opportunities, but what kind of real estate do we really want to look for? Well, I will tell you, when a recession hits, people are going to lose their houses. Yeah, why? Because they're going to lose their jobs, which means they can't pay for their houses, which means, history proves the rest. They lose their house. But somebody's got to buy that house. So somebody like you, if you're on the reservation list, you're going to be able to buy that house severely discounted. Hopefully the hedge funds don't get it before you do. And when you buy that house, you're going to be able to rent that house out to a lot of people that, well, they just lost their house and they need a place to live. So you now have the place for them to live. Okay, secondarily, apartment buildings. Yeah, you might not think people are going to lose apartment buildings, but I guarantee you they will, because they paid too much. And when they can't support what they paid out of the rent roll, because they're now looking at a 20% vacancy rate, or the vacancy rate might not even be vacancy, it's just non-payers, and they can't pay their mortgage, guess what happens? Fire sale. Fired! Don't be fired. Try not to be. But if you do get fired, make sure you got an income. And if you get fired, make sure you got no debt, so you can just be like,
you're cool, and you, I'm out.
So people are gonna need places to live. But you don't wanna buy places to live today at the prices today when you can buy them in the near future way on sale. So you wanna be looking for those. Commercial. Commercial is gonna be definitely on sale, because since the pandemic, some interesting things have happened. Oh, you already know. Right, you're still working from home, right? You didn't go back to the office, but your boss and the company you worked for still has that office, don't they? Right, so statistically, if you look, and it's different pockets around the country, but vacancy rates in commercial buildings are upward of 30 to 40%. That's right, that means 30 to 40% of those buildings are vacant. But it doesn't mean that the landlords are suffering, because a lot of those companies are still paying rent. That's right, because they had a lease. So they're maintaining the rent until the end of the term. And then when the end of the term goes, well, they're probably going to downsize. So there's going to be an awful lot of vacancy coming up. And all you need to do is do the math. The pandemic was 2020. We're now in 2023. All those leases vary in times, but let's just take an average of 5 years. You doing the math with me? You got 2 years left. Maybe 3 if it's a 6-year lease. And all those leases are going to come due. And a lot of those companies are not going to renew the lease. And a lot of those buildings, commercial buildings, are going to suffer. And a lot of them are going to foreclose. And a lot of them are going to be able to be bought by you. Yes, I'm talking to you, the one that's on that reservation list, going to be able to be bought by you at a really handsome price. And then you can repurpose it. You can turn it into storage. You can turn it into anything you want, because the next cycle at that point will be starting again. And then it really will be party like it's 2000, what would that be, 26, 27? Who's keeping track? So make sure you're saving money. Make sure you're getting rid of the debts. Make sure you're focusing on the leading indicators, not the lagging indicators. Make sure you're taking advice from the right people, not the wrong people that are delusional, because they're so caught up in their little vortex of their world that they fail to see what's actually going on. And make sure you subscribe to this channel, because I'll keep bringing you the knowledge. I'll keep you on the leading edge of what's going on, and I'll show you how to make a lot of money. Thanks for joining me. This is What Now and What's Next. Hey, if you're into real estate, what you're gonna wanna do is check out this video right here. This video shows you how to use the infinite banking concept with real estate. Check it out. See you next time.